something I know people are wondering about. We see this CME group secure a $7 billion credit facility to protect against a clearing member default.
It turns out that the credit facility was established in November of 2017, and what MarketWatch picked up on was the annual renewal of the credit agreement. But everyone knows in the audience that the market maker banks, which are clearing members of the COMEX, have had an inordinately large net short position in gold futures.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. Handsome Dave Kranzler over there already warming up, getting ready to talk some gold and silver for the weekly gold and silver report with Dave Kranzler of Investment Research Dynamics. Dave, I know you get a little embarrassed when I say this, but I've spent really the last 10 years, especially since leaving Wall Street, looking for the smartest analysts who were seeing what I was seeing, and you're really at the top of the list. So it's really an honor to have you here each week and share your insight on the things that happen, because the news is coming fast. And first of all, how are you today, sir?
I mean, it's Saturday. I'm doing okay. I have more work in front of me than I want for a weekend, but it is what it is.
Well, you got the tennis gear on there. Are you hitting the courts today?
If I can find some time, I will. I did yesterday.
Well, then we'll cut right to the action, because just a quick update, our first story here. I don't know if the audience knows this, but Dave, you're a competitive guy, which I like. And so each week he's checking. Now that we have two weekly guests, Dave and Andy, and I'll just point out, Dave, you were behind for a while. You're very close there catching up. So the pressure's on today to deliver something big, although I know we have a lot of stories. So to kick in, something I know people are wondering about, we see this CME group secure a $7 billion credit facility to protect against a clearing member default. Obviously, everyone in the gold and silver community found that a bit interesting. Then also GATA sent out that basically previous filing indicates it has had such a credit facility in place since 2017. So Dave, would love to get your opinion on what we should or shouldn't think there, and any thoughts you have on that one.
Yeah, I think the initial MarketWatch reporting of the story kind of jolted everyone because the MarketWatch presentation of the story made it sound like they had just recently secured the credit facility, and I had thought that I had no idea this credit facility was in place, and then I started going through SEC filings yesterday, and from CME SEC filings, and it turns out that the credit facility was established in November of 2017, and what MarketWatch picked up on was the third annual. It was an amendment that was filed, and it's basically an amendment that renews. It's the annual renewal of the credit agreement. Beyond that, you'd have to actually go through each annual renewal to see if terms have changed. But one thing I did discover is that the credit facility can be as large as 10. It can go to as large as 10 billion. So, rather than thinking that, oh my God, they just put this in place because they're worried about a potential default by one of the clearing members. You just say, well, why did they decide to put it in place in 2017? This probably ventures into the conspiratorial weedy area. But certainly everyone knows in the audience that the market maker banks, which are clearing members of the COMEX, have had an inordinately large net short position in gold futures for quite some time now. And the price of gold bottomed in late 2015, and it's been in a what I would call the second leg of a long-term bull market. And, I would suggest one of the motivations behind that credit facility is in the event that a COMEX market making clearing member is over its skis in its net short position and someone stands for delivery and they don't want to take cash because that's essentially what the exchange for physicals provide, is ultimately a cash settlement that is well in excess of the value of the contract, and a potential default for positioning themselves recklessly, whether it's in gold, silver, possibly oil, who knows? So, clearing members are supposed to put up a performance bond, and there's actually, I don't know, 2 or 3, you can go to the CME website and look at it. Supposedly there's 2 or 3 layers of potential liquidity that guard against a blow up from a clearing counterparty, that a central clearing party, that if one went to, one blew up, these layers or these safety nets should be sufficient. And the first layer of safety net is a performance bond that each clearing member has to put up. And so the fact that the CME felt like it needed to secure a potential $7 to $10 billion credit facility as a backup to the backup to the backup plan in the event of a default would actually tell me that there's a higher degree of systemic risk being taken on the COMEX or on the CME. It may not be the COMEX specifically, although I suspect that it is. And the reality is the banks are the ones that should be putting up a higher, the performance bond is kind of an insurance payment. It's like an insurance, it's an insurance pool, right? It's, an analogy would be, FICO insurance, right? Or FICA, whatever that bank account insurance is. FDIC, that's what it is, FDIC insurance. Yep. So analogy would be FDIC insurance. And all the banks have to throw money into a pool, to prevent, so that it guarantees, because when you put money into a checking account, the bank turns around and takes that money and lends it. And not all their loans are good loans. So it tells me that each clearing member of the COMEX should be putting up a much higher performance bond. So that's my take on this whole thing. And beyond that, I think if you speculate beyond that, it just gets too far off the beaten path.
Well, that makes a lot of sense. Although it's interesting, as you were answering that, you were saying, well, it could come into play if you had people standing for delivery or some sort of shortage of metal. I guess it was everything you described matches everything you've talked about for the last 4 weeks that we've been seeing play out. And it's interesting, as you were saying, the year 2017, I was like, remembering, I'm like, when did Terry Duffy of the CME say that gold should be 5,000 to 6,000 an ounce? There you go, 2017, which is not to say there's necessarily a connection there, but a question that I've always wondered, do guys like Terry Duffy or Jamie Dimon or Trump or, pick any other name, do they pretend like everything's normal, nothing to see here, this is solid system, it's like that scene in Naked Gun, he's flying missiles into the fireworks shop as it's exploding, nothing to see here. And, because I think back to the interview I did with Bart Chilton, where I actually asked him about that, because he was saying, he thought it was conspiracy theory when people say there's a lot more silver contracts out there than physical silver. And I asked him about that, but his answer was interesting. He didn't say, no, that doesn't happen. He said, well, that happens in all commodities, which...
That's not true.
Okay, why don't you explain, please?
Well, it would be very difficult to get away with that if you're looking at agricultural commodities or well, let's just use agricultural commodities.
Right.
You're long cattle contracts because you're a meat processor and you want to lock in the price of your cattle supply. So that was the original intent of futures. Was it was a it was a dual mechanism purpose. One, it allowed farmers and ranchers to, especially farmers, back in the day, to finance their crop. So they could go and pre-sell, say, their corn crop in the futures market. And I mean, there is a role for speculation in the futures market, but the majority of the entities that were taking the long side of those corn futures were entities that want to use the corn, that need the corn for food processing or whatever. And that's how it worked out. So let's just say, again, I don't I haven't looked at the numbers off the top, specific numbers, and ran the math in a few weeks. But if you look at, say, the COMEX, open interest in gold futures is 500,000 contracts, and I think most of that is the June gold contract. So let's say, and again, I don't know what the exact number is, but let's just say the open interest in June gold is 350,000 contracts, close enough. So you're talking about 35 million ounces of gold, right? And the COMEX in total, if you get rid of the 4GC, the enhanced gold contract, you get rid of the gold that's attributed to that, because whether or not the gold's there is another matter, but theoretically, those are gold bars sitting in vaults in London. So the deliverable gold on the COMEX is essentially, or the potentially deliverable gold on the COMEX is essentially, let's call it 10 million ounces, but that's registered and
Eligible.
Eligible. Yeah, I'm sorry, I was drawing a blank. It's registered and eligible. Now, interestingly, the COMEX sent a letter that Ronan Manley dug up to the CFTC and said, we think that on a rough estimate, half of the eligible gold is not really eligible to be registered. So, let's just say the eligible count right now is 8 million. And again, I haven't looked at the inventory numbers in a few days, so I don't know what the exact numbers are. But so essentially, the COMEX is admitting that 8 million is really 4 million. So let's just say there's 6 million ounces, 2 million registered, 4 million eligible that would be available for delivery. And you're talking about 35 million ounces of June gold contracts. So you've got 6 times more contracts, contract open interest than you have available gold to deliver, right? So if you had just 20% of the June gold long stand for delivery, you're wiping out the COMEX, the availability. And again, that 4 million ounces I'm counting as eligible, you don't know whether or not the owner of that gold is willing to register that gold.
It may be there, but I don't think a lot
Yeah.
of people holding it are going to sell at these prices.
Well, that type of arrangement doesn't happen in cattle or corn. And again, I haven't looked at these numbers, haven't looked at other contracts in a long time, but there used to be a guy around that would write about this in the early 2000s, 2002, 2003. And he pointed out, and he had gone through all and he said, all the contracts, he said, and this is at a time when the open interest in gold and silver was, maybe 200 to 300% of the underlying gold and silver reported to be in the vaults. And he said that this type of open interest in futures relative to underlying available doesn't happen in any other commodity contract. He said the closest that it comes is in energy. And typically when the open interest was more than, say, 120% of the underlying physical commodity, the CFTC would crack down on it. And there has been some cases in the past. I think it might be JP Morgan, as a matter of fact, got nailed for manipulating natural gas. This is, again, 15 years ago. manipulating natural gas contracts, and I guess the open interest had gotten uncomfortably above the amount of natural gas available to deliver on the CME. So the CFTC just looks the other way on gold and silver.
I get what you're saying, and I do, and I think, yes, there are some that it's harder to manipulate. I think there's still some credence to what he was saying. That I was surprised a couple months ago. I was looking at some of the other base metals like copper and platinum, not a base metal, but just noticing the same thing I saw in silver, which broke last year. But that pattern of, you look at the commercial short position, and based on how long or short they are, you kind of can really get some of those trends. But I guess more importantly, though, what I wanted to get from you was, like, these guys like Terry, like, I don't get the feeling that Bart saw this as a legitimate risk. So whoever's deciding about putting a $7 billion credit facility in place, or Trump, or any of these guys, do they know the stuff that you and I talk about and the risks that are there, and that it's, I mean, seems just like a matter of time? Hey, maybe it happens next week, or maybe they drag it out for a couple more years, but that when you have a fractional reserve system like this, it's going to be inevitable. Just like, again, I continue to hear that 2 market makers got blown out on the LBMA on March 24th. So, I mean, do they realize this, or are they oblivious? I mean, it's, when I was on Wall Street, a lot of people just like Keynesianism. So they get it?
Of course they know. And Bart Chilton knew. Look, Bart Chilton somewhat did an Alan Greenspan when he left the CFTC, started talking more frankly and candidly about what goes on the COMEX after he left the CFTC. That's, Alan Greenspan was Mr. Fiat currency, go ahead and issue as much debt as you want, while he was chairman of the Fed. He disappeared after he left for a while, and then resurfaced and was like, all of a sudden, a reborn gold bug, which he
criticizes Bernanke, and I'm like, well,
yeah. So that when Chilton was on the CFTC, I always looked at him as playing the good cop role versus, playing good cop, bad cop, where he's the good cop, and just, to sort of pander to the precious metals community, to make the precious metals community think that there was someone on the CFTC who was trying to right all the wrongs that were occurring. You see what I'm saying? So I never really trusted him, and I never really trusted him after he left the CFTC. I mean, didn't he went to work for some financial entity as a derivative salesman or something like that.
I mean, I don't remember that part. I think I know what you're talking about. Again, just based on my own experience, I know a lot of people have different thoughts of what really happened, or whether I never got the feeling that he was doing some sort of confession. And he was, I mean,
I'm not saying confession. I'm just saying he started covering his tracks a little bit by speaking a little more frankly and candidly about, the situation in the precious metals market. It's not like Greenspan ever, laid out a confession either. All of a sudden, he just came out as a reborn gold bug and a critic of the Federal Reserve.
And it's amazing how I don't know that I've ever heard anybody even ask him about that, which...
No, of course not. The media never asks the hard questions. They serve up softballs. You know why they do? Because if you ask hard questions, you don't get invited back to the next press conference.
I think you and I need to get some badges to one of those press conferences. Maybe there's got to be a way. Maybe we trade for a while, or how much fun would that be if we could do an episode of the show?
The first thing, if you applied to get a badge, the first thing they would do is investigate your background, find all your recent work on YouTube and on the internet, and you would get a letter back that just says denied.
I would love to see a conversation with you and Greenspan. I'm just going to keep asking Santa for it each year.
I'd love to sit down with Greenspan, man.
Maybe we could get an actor to play him, and it would still be fun. Who knows? Dave, we're going to let you run, finish your journal, and hit the courts. Although I got one last quick one here for you. Obviously, there's a lot of attention coming into gold in particular. I think soon will be the case in silver. You and I are conspiracy theorists and all that. But for people who know or might be new to all this, and they read things like, here's an article on Kitco where conspiracy theorists are once again out in force, spewing their ignorance about markets being manipulated. All markets need is a buyer and seller to complete a trade. How can that process be manipulated? I understand the word manipulation gets people sometimes fired up. Whatever you want to call it, I mean, to me, it just seems somewhat relevant that at least there's a possibility. I think it's exactly what's happening, that often the banks sell at large amounts of paper gold that they can't deliver. So whether you call that manipulation or what, just like any thoughts on this debate that's always been ongoing in the community for folks who may be just getting into gold and silver and wondering what is the real deal?
I mean, I'm not quite sure what exactly you're asking me. I mean, are you asking me, should we care whether or not the market's manipulated?
I mean, I guess I was just trying to get you a little riled up by this guy calling you a moron, spewing your ignorance, and just that
you know,
there's a couple. Just that there's a lot of folks out there that say if you think that the markets aren't trading cleanly, you're just delusional. Yet the main reason I left Wall Street was because I couldn't figure out how else these things were being priced. And just for folks who may be new to gold and silver and see this debate going on, any quick thoughts there?
I think that, well, first of all, when Gata showed me that article, I first saw, well, it's not surprising that it was released by a Kitco reporter. And I looked at the title and I was just like, you know what? I don't have the time to waste or the brain cells to waste reading this article. Now, I mean, there is, I guess if you're interested in buying physical gold and silver and taking possession of it and safekeeping it yourself, you actually should be welcoming the manipulation, right? Because it enables you to accumulate an extremely valuable asset and an extremely valuable wealth preservation vehicle at an inordinately cheap price. Mm-hmm. So if the market traded freely, the true price discovery price would be multiples above where it is right now. And eventually we're going to get there, because I think eventually China and maybe China and Russia together are going to force the issue if some large entity that's not China or Russia decides to force the issue, probably on the LBMA, not the COMEX. But I mean, I've always said, people for many years, there have been, these people that are, bummed out that gold isn't higher, blah, blah. And they're like, well, why doesn't China do something about this? And it's like, why would they? I mean, they've accumulated thousands of tons of gold at a much cheaper price than they would have been able to otherwise. So, again, it kind of gets back to a futures market. I'm okay if you have open interest that somewhat exceeds the underlying amount of physical available, because it gives speculators an opportunity to come in and give the market some liquidity. It makes the market a little more liquid. But when you get to a point where the paper derivative has absolutely zero bearing on the actual real supply and demand situation of physical gold, then that's where you can get hurt by manipulation. And getting back to that credit facility, at some point there's going to be some banks that really get hammered by their net short position in derivatives. We only kind of know what that position is looking at the COMEX numbers, right? I mean, we don't really, I guess if you're a member of the LBMA, you can probably figure it out over there. But there's also OTC derivatives that are completely opaque, other than the quarterly reporting to the OCC, and who knows how those are structured.
Yep.
So just looking at the COMEX and saying, oh well, that's the paper to physical short interest. No, it's not, because there's several other mechanisms that have kind of created derivative shorts, like central bank gold leasing, things like that, hypothecation of gold bars, right? You're short contracts to China, you're JP Morgan, and you don't have enough bars in your vault to deliver that are your bars, so you borrow customer bars, you hypothecate them, the customer will never know, and we'll replace those bars, and the customer's never going to take them out of our vault anyway. So you take those bars and you deliver them to China. And don't think for a second that hasn't been going on, because it's been going on for years. And I actually think we are getting to, we're getting very close to a day of reckoning when someone's going to force a true up between the paper derivative open interest in paper gold and the actual amount of physical that's out there that can be delivered under those paper liabilities.
Yeah.
So, I guess if you're short the market, you probably should be scared that the market's manipulated. But if you're short the market, the way these banks are, you're part of the manipulation. So, I guess it's like, you're right. Who cares if there's manipulation? If you're an accumulator, you should embrace it. But eventually, it's going to cause real problems in the system.
Yeah, I sure appreciate you.
And until it does, we're going to continue to see idiotic articles by guys like Bubba Horowitz.
Well, I appreciate that. And again, I think people are wondering. With that said, Dave, I'm going to let you get running, although I will just let you know that it's Saturday, and I'm excited to go through this, which is this week's Mining Stock Journal, which you can find at investmentresearchdynamics.com. And even, Dave, you even share a lot of free stuff on your site. And then if folks want the Short Sellers Journal, how to short this massive bubble the Fed is now pumping up again with unlimited QE. And then also you have the Mining Stock Journal, where you dig into gold and silver twice a month, as well as the gold market, $20 a month, which I think is quite a great deal for people. So I thank you for joining me today there, Dave.
Appreciate that, Chris.
And folks at home, if you love this and you want more coverage of what's going on in gold and silver, stay tuned, because we have another video coming your way.